It's Wednesday, July 29th, and we're recording this around 12:30 p.m. Eastern Time. Right before the FOMC meeting, the markets are down intraday. The Nasdaq is down as of 12:30 p.m., about 1.4% intraday. The S&P 500 is down. Why are markets sliding right before the FOMC conference? What are markets expecting out of the Fed, not just for this meeting, but long term? We're going to answer these questions and much more with Milton Berg, founder of MB Advisors. Milton spent decades on Wall Street, previously at Oppenheimer as well. And he's been a fund manager for many, many years on Wall Street. Now he manages institutional clients. Check out his work, link down below. Milton's going to give us not just a rundown of what we can expect today from the FOMC. Everyone's expecting rates to be unchanged, but what happens next? How many rate hikes can we expect later in the year? How will markets react to rate hikes? Will we get a major bear market like in 2022? Well, spoiler alert, Milton is tactically short right now. We're going to find out why. And this video is brought to you by KOSPI. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started. And new users who use my code LIN, L-I-N, can get up to $500 when you trade $25. KOSPI is CFTC approved and available in all 50 states, including California and Texas. And right now, there is a trade for the number of Fed rate changes before 2027. Traders are predicting that there's 30% chance of exactly 0 changes, exactly 1 rate change, 41%, and exactly 2 rate changes, 19%. I want to stress that perhaps these are hikes, not cuts. No one's predicting a rate cut this year. If you place $50 down on exactly 0, for example, because that's what you believe, then your payout may be $142 if you turn out to be correct. Again, link down below or scan the QR code here. Milton, welcome back to the show. Good to see you.
Thank you for having me. Great.
Milton, last time you were on the show, I believe we spoke before the Iran war started, so it's been quite some time. Volatility has been the name of the game in the last couple of months. And I want to ask you right now what the key variable is, or number of variables, if you can narrow it down to a few, that you think are the most important for moving markets going forward. Now, we're speaking right now at 12 p.m. Eastern Time, roughly 12 p.m. Eastern Time, right ahead of the FOMC meeting. It's expected that no rate hike will happen today, but you told me offline that they are likely to raise rates later this year. So give us a teaser on what we can expect later today at the FOMC, and ultimately what you expect the Fed to do
First,
this year.
I'd like to say, I believe Kevin Warsh may prove to be the greatest Fed chairman in the history of the United States because he's very well educated. He understands monetary policy. He's not influenced by politicians or by politics, and he's serious about fighting inflation. Since he is serious about fighting inflation, it's highly unlikely that he'll do nothing at the current meeting because we're now in the midst of 5 years or so of inflation above the Fed's target of 2%. I happen to believe that Kevin Warsh will probably lower the target to 1% or lower sometime during his reign as the chairman, because a 2% inflation really is not acceptable for savers. And I think Kevin Warsh really is interested in the American public and the retail public to be able to have the currency maintain value rather than have it lose 2% per annum. So today, I think at least he'll go do something. I think he may do some quantitative tightening, which would be selling some of the bonds on the balance sheet. I think he may make an announcement about reducing the balance sheet. I also think it's likely they will raise rates, even though the consensus is they won't raise rates. I think it's likely they raise rates not because of oil prices or because of inflation, but I think they'll likely raise rates because the 2-year yield is now at a high, and the Fed historically has always followed the two-year yield. They never let the 2-year yield get ahead of them. If the 2-year yield is rising, they're going to raise the short-term rates. So I think I'm against the consensus. I think it's more than 50% likely they'll raise rates. And I think it's definitely likely, 100% I'd say, you can never say 100%, but they will definitely do something.
Why is Kevin Warsh going to be the greatest Fed chair of all time? Fundamentally, what is different between this Federal Reserve and Jerome Powell's?
Well, Kevin Warsh was a real Wall Streeter. He was involved in markets, involved in asset classes. And I know from his background and just hearing him speak and knowing his education that he has a total grasp of monetary policy. And I don't believe he's a Keynesian. I think he's more of a monetarist. He's more eclectic in his approach. And therefore, I think he will be one of the greatest. Why I say one of the greatest? Now, maybe one of the greatest. I think Paul Volcker was good as well. But Paul Volcker came within a major crisis, and he knew exactly what to do. He had to get inflation down from 10%, down to 6.543%. Now we're not necessarily in a crisis. We're just in a situation where we have inflation that's higher than it should be, and that most Fed chairmen would just sit back and be patient and wait and think rates are coming down or think inflation is coming down. But I think Kevin Warsh is a man of action. He's a man of integrity, and that's really what you need. You need a Fed chairman who will not be influenced by Wall Street pressure or by political pressure, and he'll do what's necessary to bring inflation down. And I think he stresses that the most important part of his mandate is keeping inflation low. In other words, keeping our currency strong, or keeping our currency allow savers to ultimately make money by saving the money. And I think the idea of employment, with the Humphrey Hawkins mandate was to have low inflation, low unemployment. I think it's a secondary factor. I think he believes that once you have a stable economy with low inflation, automatically the unemployment rate goes down and the employment rate goes up. Now, actually, we're in a very good economy currently because, as you know, you had the 187,000 people filed for unemployment. We had the lowest filing for unemployment since 1969. We're really in a very, very pretty good economy at this point. In a good economy, he doesn't have to worry about tightening a bit. If we rolled over into a recession or a slowdown, maybe the Fed chairman will have to worry about tightening. But in the current environment, with inflation high, with the economy strong, there's really no reason he should hesitate. And I believe there'll be some action in 2 hours from now at the meeting.
How would you, as an investor or fund manager, look at Fed responses to data when Kevin Warsh has made it clear at the last FOMC conference that he is going to not give forward guidance, and perhaps they won't even use dot plots anymore. So it's very difficult to see what he might do next.
Well, to see what he might do you have to put yourself in his shoes, and you have to look at the data yourself. And again, just looking at the data, you have a strong economy, no reason not to tighten. You're not going to cause a recession by starting to tighten. Inflation is higher than it should be for 5 years. You got to do something about it. And interest rates are moving up, and maybe they're moving up for positive reasons. They might be moving up because the economy is strong. And when interest rates move up, the Fed doesn't want to fall too far behind the natural rate of the market. So it's clear that if I put myself in Kevin Warsh's shoes and look at the data he looks at, that's all you got to do, and not worry about information that's really not relevant, like oil prices are really not relevant to Fed policy. Fed should just ignore oil prices. Oil prices is a political issue, and if oil prices go up, other prices should come down in a true economy that's managed properly.
All right, there's now a 41% chance. This is prediction markets. This is KOSPI. Prediction markets, I like to look at it. They've been pretty accurate up until the closer you are to the actual event itself. Number of Fed rate changes before 2027: exactly 0, 30%, exactly 1, 41%, exactly 2, 19%. Know that the wording is Fed rate changes, so it could be up or down, but I looked at another prediction. No one's predicting the rates are going down. So exactly one rate hike is 41%. Does that seem a bit low to you?
Yeah, I think it's a little bit low to me, but I think the key isn't the rate hikes. For Kevin Warsh and for myself, the key is really the balance sheet. The balance sheet is way too large. You have a balance sheet you need in a war zone. When the United States is at war. Now, I guess they are at war. But the truth is, he got to get that balance sheet down. And to me, that's more important than raising the rates. Raising the rates is more of a crude method of getting inflation down, but cutting the balance sheet, which is actually directly affecting money supply, is far greater, has a far greater effect on the inflation rate.
Okay, so exactly 2 rate hikes, 20%, and no rate hikes. Let's take out the no rate hike situation. What happens if we get 2 rate hikes, Milton? Is that a little bit aggressive as a policy?
2 rate hikes. There was once a famous market technician, Edson Gould, and he would claim the market doesn't peak until you get two Fed hikes. One is not enough to peak the market. So as a technician, looking back at history, you'd say if the Fed raises rates twice, then you may have to worry about a market peak. It doesn't really work as well as it's worked in the past. But one thing we do know, no major bear market has ever occurred without a Fed hike. So currently the Fed has not hiked. So I don't think it's highly unlikely that you're going to have a major market peak now, even though it looks pretty bad. I still think what we're seeing now is corrective action. And on the other hand, if they raise rates once or twice this year, that might slow the economy, and a slowing economy itself can cause a a bear market. You don't need a recession to cause a bear market. A nice slowdown in the economy, especially when the stock market is overvalued as it currently is, can cause a correction. Now, I'm more concerned about the stock market than I am about the economy. I'm not an official economist, but I'm an official stock market tracker and technician and market analyst. And to me, I like to focus on markets. And I think that at this point, even if, as they say, Kevin Warsh may be the greatest Fed chairman in history, may prove to be, doesn't mean he's going to prevent bear markets. He shouldn't be worried about what the stock market does. He should worry about what inflation does and what the real economy does. And I think.
And when you final question on the Fed before we move on to the markets, when you say that he's going to be the greatest Fed chair, what metrics are we using to evaluate how good or bad a Fed chair is?
Well, the number one is, will he get inflation to below 2%? That's really the first thing. And secondly, how will he do it? Will he do it in a responsible way, in a way that doesn't affect the economy, doesn't shock the economy? Or will he do it in an irresponsible way, where he'll let the market tell him what to do, wait till inflation goes up a little more, and then panic and start raising rates 0.75%, 1% at a time? I think he's astute enough to anticipate the future, and rather than wait for the inflation to get ahead of itself, I think he'll anticipate and do what's necessary to bring rates down. You want to have you don't want a heavy-handed Fed chairman. You want to have a calm Fed chairman who makes decisions from month to month and follows the data. And I just think he'll do that. And again, he's been on Wall Street. He's been involved in markets, and that's something that most Fed chairmen didn't really have or weren't successful at.
All right, let's look at how markets are behaving today, and then I'll let you share. I'll share my screen very briefly, and then I'll let you share yours. So today we're looking at a steep decline ahead of the FOMC meeting. The Nasdaq is down 1.4%, and the S&P is down about 1.1%. Gold is actually also down about 60 basis points. And Treasury yields are up slightly. So this is right before the FOMC meeting. I wonder why there's a sell-off before the FOMC. I wonder if that's related or related to maybe something else. Let's see what oil is doing right now. Oil is holding steady around $85 a barrel for the WTI. And I had up the SMH, which is Semiconductor ETF, the VanEck Semiconductor ETF. That actually has been falling for quite some time now. It peaked in late June, and it's down already 25%. I'm just making the point that certain subsectors within tech have already experienced a bear market. Intel's already down more than 40%. And across the pond, SK Hynix in South Korea is down 50%. And Sandisk just went down 14%. So just a couple days ago. So while the overall tech index, the NASDAQ, is holding up steadily, close to its all-time highs, the semiconductors have already been selling off. I wonder if that's a leading indicator for anything else, but we can talk more about that. But broadly speaking, why are we seeing a sell-off today, right now at 12 p.m., 12:20 right now? Yes,
Okay,
please do.
well, today's sell-off is just a continuation of the sell-off that began in mid June. I don't put much weight in any one day's action, because I believe that every single day's action is really random, except the trend has been down since June, at least for these indexes that you've exhibited, and therefore today's decline. Now, there's something else we do. It's work that we do. It's interesting that I'm meeting with you today. First of all, it's a Fed day, which is a very important day. It's also a cycle day. We do some work based on the great technician Paul McRae Montgomery, and today, actually, the week starting Monday through Thursday was a clear cycle week where some markets worldwide should bottom. We actually took a 1% position in the KOSPI this morning, because we believe that there's a higher probability than random that this decline will end, at least for the short term, and the market will bottom. And one of the reasons we say that is because of the cycle day currently. Let me show you a chart of the KOSPI. This is a report we just sent out this morning. We're positioning along the 1% in the KOSPI. Now let's look at the chart of the KOSPI and see what we see. Okay, as you can see, the KOSPI has declined some 38. I don't have the exact percentages, it's not here, but KOSPI has declined significantly off its highs, and it was a very speculative type of a market. It was a market in which the people in South Korea were leveraging themselves up to take advantage of the high tech gains. However, you notice the decline was very, very, very orderly. You see, if you look at the decline, you don't see any gaps to the downside. You see a minor gap right here, which was filled, but no major gaps to the downside until day before yesterday. You see, so this kind of action is often exhaustive. It's telling you that the market is setting up for a low and for a reversal. Considering that we're also at a cycle date, And let me get the KOSPI up on here to exactly how it's declined. Yeah, KOSPI declined 43.93% to this morning's low. So we just took a shot today, and as I say, it's a cycle, Montgomery cycle date. Now, the Montgomery cycle date, I don't want to take too much time with you, but it called the top in gold, which we shared with our clients. We actually got out the day of the top on January 30th of this year, and it also called some of the something else. Let me give you another example. You see back over here, you had a Montgomery cycle date from the 10th to the 15th. That was the recovery high. If this was the final high in the S&P on June 2nd, the recovery high was July 10th and July 15th. That was a cycle period from 10th to the 15th, you see. So this is a reason to believe that this corrective action began in June. We pulled back up to the cycle date, made a cycle peak, recovery peak into a cycle date, and now we're heading down. Now, the S&P is not really heading down that dramatically. It's really the NASDAQ and the stocks that's heading down dramatically. But these are the kind of things we look at, and this is why we thought we're in a corrective pattern rather than a continuing up move. Now, we're not looking for a bear market at this point, and I'll tell you in a minute why. We're just looking for a correction, but a correction could be 5, 6, 7, 8, 9%. The S&P did decline 5.03% into June 9th. At this point, you would not believe that's the final low of this correction, but that idea may change. This shows an island reversal at the first recovery high, which is negative, and here you have a peak on cycle dates, which is also negative. That's the S&P 500. To show you something interesting, the S&P 100, which is the 100 biggest stock in the S&P 500, shows a different pattern. On that July 15th Montgomery cycle date, it gapped up, which is exhaustive, and that was the final recovery high for that index. So based on the technical things we look at, we're looking for the markets to decline. However, the KOSPI, which has declined so dramatically into the cycle date, we're willing to test the waters and go 1% long the KOSPI. If it works, if we see evidence of a turnaround, we'll probably add to the position. If the lows don't hold, we'll just get out of the position. But that's
Sorry, what's a Montgomery cycle?
Okay, Montgomery, you have to follow the work of Paul Montgomery. I don't want to tell you exactly what's involved, but he has generally every year there are 2 periods during the year in which markets are prone to top or bottom. It's a reversal cycle. You don't know what's going to call a top or going to call a bottom, but in the current instance, where the markets peaked in June and we knew there was a cycle in July, we told our clients it's highly likely they'll get a spike low into the July cycle, which is exactly what we're seeing. You're seeing spike lows. Whether these lows hold or not, in other words, a cycle work, no matter what type of cycle work you use, or whether it's seasonality, it's all highly speculative. Realize we're not claiming that cycle work is something you can get a PhD on. You understand? Cycle work is highly speculative, but you have to be an expert to know how to use it. Not every cycle is going to turn every market, but the reality was with the kind of action you see in this market, it's more than random. It's probable that you're going to see some sort of a turn. This is the Philadelphia Semiconductor Index. To show you interesting, technically what you saw a double island top. You saw a 2-day island top into the exact peak. Island top means get a gap into the high and a gap off the high. In other words, it leaves an island, leaves a space between between on the way up and a space on the way down. So you have a 2-day island top in the stocks, and you also have a 5-day island top right here. You see, in other words, it gapped up into here, wasn't the final high, then it gapped down. So you have a double island top, which is technically a sign of a reversal. And then finally, the market declines down 26.31%. And today's Montgomery data, right? Montgomery date low. Maybe this will be the low. I mean, let's face it, the market's down 26%. And at the same time, the equal weighted S&P 500 is at a new all-time high. As you know, you may have heard this. If you look at the individual stocks of the S&P 500, they're at an all-time high, which tells you that perhaps the semiconductor decline is just a technical decline. It's a decline because it got overvalued and overchased to the upside. But maybe it's not reflective of what's going on with the market as a whole. And maybe it's not reflective of what's going on with the economy at all. So anyway, this is what we're looking at. We're still short. We're short semiconductors. We're short the NDX and we're short the OEX. Those are the 3 indices we're short for the institutional investors. We got short in June and we're looking to cover, but we haven't covered yet.
All right, you're short, but for now,
short, yeah.
if you believe that perhaps maybe a technical decline, doesn't that indicate to you that it's a good buying opportunity of something you just felt because it's overvalued or corrected? It went back to its mean. Doesn't that mean that investors looking to get in now is a good time?
That's a very good question, and that's a very good question. A fundamentalist would ask that question, but Nish would say, well, if it got overvalued and pulled back to the mean, what's to tell you it won't get undervalued and go below the mean? We need evidence that the market is bottoming. The main evidence we have now, as I said, it's a Montgomery date, and you had in the KOSPI, you had the exhaustion. In the KOSPI right here, we had the exhaustive gap right here, so far 2 days before the low. So we're looking for evidence of a low. It's not enough that the market has corrected somewhat. Now, of course, an institutional investor who's quite bullish on the semiconductors should start scaling in and buying into weakness on an assumption that we're not in a bear market. Our assumption is we're not in a bear market. We'll get to that in a moment, but things could change. Maybe for some reason, if Kevin Walsh raises rates by 3%, or interest rates rise dramatically, and the economy unexpectedly turned into a slowdown, and maybe the June peak was the final peak. Now we have some interesting things we saw at the June peak, which I guess I can show you, but let's just look at a little bit individual stocks for a moment. We talked about macro. Let me show you a chart from a friend of mine. Now I can't confirm. This is a fellow named Danny Perchik, and he tracked all market crashes in history, and he's tracking it against the current Nasdaq 100, and he says we're right around here. You see,
Right.
so sometime in the very near future, if he's right, the market should start making lower lows and lower lows and lower lows. And if you just look at today's action, the markets are making lower lows. Will that continue? I'm not so sure it will continue, but meantime, we're short as well. But this is an interesting chart. I guess you can get it on the internet. His name is Danny Perchik. But this is just an interesting chart. You can't trade based on this chart, but it's just something to look at. I want to show something else very interesting. At yesterday's close, more than 50 of the S&P 500 stocks made new highs. Okay, yesterday the market was a low day. The S&P had been down some 3% off its high. Yet 54 stocks, more than 50 stocks made new one-year highs, which is kind of interesting. Actually, no stocks made a one-year low yesterday, despite the fact that you had such a weak market in the Nasdaq and in the semiconductors. Not one stock in the S&P 500 made a new 52-week low yesterday, which would be positive. But at the same time that the S&P showed more than 50 new highs, the Nasdaq was down 8 out of 9 days. Now, does that tell you anything? Normally, you'd say this is so strange. How can you see 50 new highs in the S&P 500 with the Nasdaq down 8 of 9 days? Now, it only happened twice before, but I want to show you something fascinating because it happened once here in 1985, and the market declined another 4.5% before bottoming. Nothing to worry about. But the exact pattern took place in January 7th, 2022, at the market peak, at that bull market peak. The bull market peak on the 4th, and on the 7th, the S&P had 54 new highs, and Nasdaq had been down 8 out of 9 days. So this is something, again, you can't trade based on this. This is giving you a flavor to what's going on in the market. So while I'm telling you, I still believe we're just corrective action, I'm going to show you the fact that it's 54 new highs, and many pundits have been saying, wow, there's so many new highs in the S&P, it must be bullish. And I'm saying, well, look at January 7th, 2022. There were 54 highs in the S&P. The Nasdaq had already peaked back in October, as you remember. October 2021 was when the Nasdaq peaked, and the S&P peaked in January of 2022. So you can make the argument, wow, it's a positive divergence. 54 new highs in the S&P with the Nasdaq down for a month and a half, but it turned out to be a negative divergence. The Nasdaq won, and the S&P went down another 24%. So these are the kind of things we look at. Now, the question you might want to know, David, is why am I not really am I very, very bullish? Am I very bearish? Why am I saying that I think it's just corrective action? I think it's a very legitimate question. I think this action is corrective and will probably make higher highs later on in the year. And the question is, why do I say that? Is that an interesting question, David? What do you think?
I think, yeah, it is, and I'd like to know also why you think the markets haven't bottomed yet. You said we have to wait for confirmation that the market is bottoming. What kind of confirmation would that be, Milton?
So let's look at one of the reasons why it's not likely that we're seeing the low at this point. Why you need more evidence? Let's look at the SOX index, because the SOX index was leading to the downside, and let's look at the volume. Look at the volume of this here, which is right here. Okay. Now you see not much of a spike in volume, you see? Usually, when the market's down 23, 24%, and the market's going to bottom, you start seeing panic selling spikes in volume. You don't see any major gaps to the downside into the lows. You see there was a minor gap 2 days ago, just a minor gap. Usually, this is a minor gap. The low the prior day was 11.1217, and the high was 107.99, a minor gap. But usually you see larger gaps into it. So you see panics into a bottom We haven't seen the panic yet. So that's one of the reasons I say I need more evidence. Also, the majority of our models, which call market bottoms, don't call the bottom to the exact day. They call it 1, 2, 3, or 4 days after the low when you see reversal action. So maybe this market bottomed today, but maybe we will see the evidence of the low of the reversal action, 1 or 2 or 3 or 4 days from now. So that's the answer to that question. Why, even though I think we're in a correction, why we not have bottomed yet? Why I need more evidence? But let's face it, the S&P's low was on June 9th. The S&P has not declined below its June lows yet. So if this is a correction in the S&P, it's kind of strange that you just had about a 6-day correction into June 9th, and now it's way above that level. So we think it's likely or possible the market will trade even lower. And on the other hand, we don't think it's a bear market yet at this point. Now, I can give you some reasons why we don't think it's a bear market, and let's get to that. I might as well do that, right?
But you said we're not, but you're still short though.
I'm still short. Yeah, I'm short. It's called tactically short.
Okay.
We're short. We're tactically short where we're okay. The market bottom March 31st, 2026. Okay. From March 31st, we got a number of buy signals. Each thing on the left is another buy signal, you see? And these are the dates of the signals, March 31st, April 10th, April. Anyway, if you like, I'll show you the signals in a minute. But looking at the history of these signals, in other words, what has the market done in the past when these buy signals were generated? So, for example, this signal here saw a minimum return within 12 months of 19.70%, a median return of 26.47%, you see? So what we do is we looked at all of the signals we got in April, and we looked at what is it projecting for the market to do currently if it follows the previous path. So the minimum projection based on the signals we had in April is for 82.8621 in the S&P 500, which is a gain of 11.54% from the current price level. The median gain would take us to 89.5823, which is a gain of 20.59%. So I built these models, and these models work very well. Certainly work directionally because the market zoomed off the April lows. As you know, you have some stocks up 100, 200%, and you certainly have, even the semiconductor index itself was up 100%, and all major averages gained. Whether it's the S&P 500, S&P 400, S&P 600, or the Russell 2000, they all gained. So on a directional basis, our model worked. But we also expect the projections to likely work. So we're not willing to call a bear market unless we see the projections failing.
I see.
Is this clear
Okay.
a little bit? If it's clear, then I can take it to the next step.
Yeah,
If this
got
is
it.
clear-
Yeah, that makes sense. I'd like to ask you some more fundamental questions to close off, Milton. So, ahead of the Federal Reserve, what do you think the Fed needs to say to turn markets around? In other words, right now, like we discussed earlier, the markets are still down about 1%. The Nasdaq's down more than 1% intraday. If by the end of the day markets have to close up, what would the Fed have to do to turn this around?
Turn it around on a short-term basis?
Yeah, let's say the Fed says something to turn the markets into the green by the end of the day. What would you anticipate that to be?
Well, if the market is anticipating increase in rates based on the 2-year and the 10-year, and if the market's increasing, anticipating a quantitative tightening, and if that's the reason the market's declining, if the Fed announces they're going to sit on their hands and do nothing, that's likely to get a recovery rally in the market. I don't think that's likely to happen, but that could happen.
Okay.
So that's what it would be. That's what it would take, basically.
I see. Milton, then wouldn't that basically confirm that inflation is no longer that much of a concern?
If the Fed does that, they say inflation is no longer a concern. You're asking a theoretical question, and I believe inflation is still a concern. I think that the Federal Reserve believes inflation is a concern, and I don't think they'll sit on their hands and do nothing. But if they do, you'll probably get a rally.
I see.
You'll probably get a rally.
All right. 2022 was the last time we got a Fed rate hike cycle. Is this going to be as bad as 2022 for the markets?
2022 is misinterpreted by most technicians and fundamentalists.
All right.
The bear market began before the Fed tightened. Bear market began in January when Putin went to war against the Ukraine. The Fed didn't begin tightening in May, and the Russell 2000 bottomed in June. So the reason for that bear market really wasn't based on Fed tightening. The reason the bear market was based on the fears that the world would go to war, and the fact, of course, that I believe as inflation was increasing. But the Fed didn't start fighting inflation until May. And in June, they went aggressive. I think they raised 75 basis points. And in June is when the Russell 2000 bottomed. And the S&P bottomed in June as well. It made a test of the low in October, less than 3% below the low in June. So as I say, I think the market misinterpreted that. Then the Fed continued tightening, and the market continued rallying. You see, from October of 2022, the market bottomed. The Fed was still tightening, and the market continued higher. So I'm not so sure that you could just look at a previous Fed action and extrapolate for that to happen at this point. So that'll be the story. Of course, an aggressive Fed tightening that's going to cause a recession is going to cause a bear market. The tightening in 2022, even if you're going to suggest that the tightening is what took the market down, it did not create a recession. And people were banging the table looking for a recession. As you know, most economists at that time was looking at the inverted yield curve, calling a recession. And we, using technical work, we said that the market bottomed in June and tested it in October. And we were pounding the table to go long. And, we don't like to predict recession or not, but the likelihood was if the market's going to bottom and rally, that there won't be a recession, and there wasn't one. So in short, it would take more than one rate hike to top this market, but there may be other factors topping the market. Let me show you some other factors that may be topping the market. The market is not necessarily a healthy market. Like let's look at here. Let's look at this one. Net credit balances. You see, this is what supports market is margin debt, and margin debt relative to cash is at the lowest level in history. Now you can't trade based on this, but if the market starts correcting and people who have margin debt are going to have to cover the margin, that could put pressure on the stock market. It's at the lowest level in history, as you can see. The 2000 market crash took place at this level, and the 2007-8 was predicated on this level. And right now we're at the lowest level in history, which means that the market is on a tight wire. The market can collapse at any time once investors lose confidence that they'll be able to cover their margin debt. That's one thing to keep in mind. And realize one thing, when rates go up, it's much harder to cover the margin debt because margin rates go up as well. That's one of the reasons when the Fed raises rates or natural interest rates rise, one of the reasons it affects the market. And in reality, natural rates are rising. The 30-year, the 10-year, and the 2-year are all at 1-year highs. And if they're going to go higher, which I'm not going to project the bonds, but if they go higher, that should have an effect on margin debt. So that's one of the things we would look at as far as why the market might be topping. And then we showed you all the various charts that were suggesting that the market may, at least in a corrective mode. I want to show you something very fascinating. And this is the market in the year 2000. I say this because everyone's missing this currently. People are pointing out that the equal weighted index made a new high, and that's very bullish. I pointed out myself. The S&P 500 equal weight index made a new all-time high yesterday, as did the S&P equal weighted 1500 index. All 1500 stocks made a new high. And people are arguing, wow, that must be the S&P must continue higher as well. Let's look what happened in the year 2000. It's just amazing, and it's amazing that people don't follow this. And even though I put this on Twitter for anyone to see it, I don't see anybody replicating this. This is the peak in 2000. Remember, the S&P went down some 46 or 50% off its peak in March 24th or so 2000. Look at this is the red line with the shaded blue. The black line is the S&P unweighted index. You see, the unweighted index rallied into May 21st, 2001. The S&P peaked in March 2000. The unweighted got higher and higher into May of 2021. I think it gained. It's not here in the chart. I think it gained at least 18% from 2000 to 2001. So imagine throughout this bear market, and NASDAQ was really getting killed, much worse than the S&P. Imagine technicians or fundamentalists pounding the table and saying, no, this is just a correction because the S&P equal weight index is making new highs. It's a meaningless data. It makes new highs because it doesn't take much to move the smaller stocks in the S&P 500, and the smaller stocks didn't get overvalued like the big stocks did. Now, currently, it's the semiconductor stocks, the technology stocks, the electronic stocks, meaning those that are involved in data centers and so on, that got overvalued. And maybe the great bear market will be just those stocks going down with the rest of the market remaining flat for a while. The fact that you had 54 new highs yesterday, and the fact that the S&P 500 and 1500 on an unweighted basis or equal weighted basis made new highs, really doesn't tell you anything. It just tells you that those stocks are doing well while the rest of the market is doing poorly. What's going to happen in the future with the S&P 500 it has to be based on other types of information. One thing we do, we publish anytime the S&P is at a market peak, we publish what we call technicals at the high, which shows the technical data that occurred at prior market highs. If it's yellow, it means the data is consistent with information seen at prior market highs. For example, on June 2nd, there were 30 new highs in the S&P. Now, previous market highs, you saw as high as 82 new highs. So that was inconsistent. Anyway, this is what we look at, and they're all yellow, which means it's consistent with the final market peak. But again, you can't say that this is a guarantee that you're headed for a bear market, because the market could correct and then make another high at other levels. There's actually, yeah.
Anything that could, in terms of sectors within the S&P or NASDAQ or commodities or any other asset classes that would do well during a rising interest rate environment, Milton?
Well, I would tell you this. Well, this is the wrong one. This is just, I got out of my gold, my personal gold, on January 29, 2026. This is my check that I received. Just
you got out exactly on January 29th,
yeah,
the day before the big correction. Okay.
I told my wife, I woke up in the morning, I saw the night trading at night. I told my wife, I got to go to the gold dealer. I got to sell my gold. And that's what I did. So people didn't believe me. I actually showed a copy of the check. But the point is, why? Why was it that we decided to...
that is the most remarkable example of timing I've ever seen
yes,
on this show yet. How did you know? I mean, you probably didn't.
How did we know? Okay, let's look at gold. How did we know? So first of all, as you know, people were going crazy about gold. They say, wow, now's the time to buy gold inflation. I showed this chart. I say, listen, this is gold by GDP-weighted currencies. Right here, they're saying now's the time to buy gold. Look at it right here. I'm making this, see right here? Now's the time to buy gold. You look at the chart, you could say, well, maybe this is the time to buy gold. Maybe now is the time to buy gold. Even maybe now is the time to buy gold. But how could anyone just looking at charts say now is the time to buy gold? But everyone was saying it, number one. So basically, there's a mania, illogical mania. Secondly, I said the following: gold is really just a commodity. People like to make it in some sort of religious object, or a holy, some holy object. But gold is really just a commodity. This is the ratio of gold to crude. Now, gold to crude in January got to its highest level in history. Now, why? If gold is a commodity that moves up with inflation, so too is oil a commodity that moves up with inflation. So if gold is anticipating inflation, why isn't oil anticipating the same inflation? So the fact that gold got way above the ratio to oil where it's been in history, I mean, historically it should be down here, you see? So anyway, that was another reason to tell you this mania in gold makes no sense. Even if there will be inflation, gold got ahead of itself. By the way, this peak is when crude went down to zero. We recall during the COVID crisis, for a couple of days, they couldn't store any crude, so crude went down to zero. That's this spike. This spike wasn't an increase in gold, it was a decrease in crude. But this spike basically is an increase in gold relative to crude. That's another thing we looked at, a gold relative to crude. Then we looked at something else. Let's say inflation. Well, doesn't inflation bring up housing prices as well? Inflation doesn't bring up gold, it brings up housing prices. In January, this is the ratio of gold to the typical median sales price of a home in the United States. And this was the peak in 1980. This is the peak in 2011, and this is where we were then. I said to myself, if gold is truly moving because we're headed for hyperinflation, like people were saying, then housing prices should also move up because we're heading in hyperinflation. You look at Zimbabwe, or you look at Germany, when they had the hyperinflation, it wasn't just gold that went up in price. It was housing that went up in price. It was oil that went up in price in their nominal currency. Anyway, this is another reason to tell us that. And then the most important chart, which I pointed out in my report at the time, was this chart. This is from the report, January 29th. You see, it's the day I sold my gold. The day we recommend our clients to go short, yeah. January 29th, 2026. Look at gold relative to the CPI. If gold is telling you that inflation is going up, well, in 1980, gold relative to CPI is here. Now it's twice as high as it was relative to CPI than it was in 1980. Now, why isn't CPI moving up? Now, of course, Peter Schiff will tell you that CPI is not measured properly. I'll agree, CPI isn't measured properly. But I know that if I take an ounce of gold on January 30th, 29th of 2025, and I wanted to buy a couple of cans of Coca-Cola, I'll buy many more cans of Coca-Cola than I ever would have bought in history. Because the price of gold relative to Coca-Cola was the highest in history. The price of gold relative to Hershey bars was the highest in history. The price of gold relative to a loaf of bread was the highest in history. The price of gold relative to cumulative inflation was the highest in history. The price of gold relative to oil was highest in history, which told me that gold is not anticipating inflation. Gold is ahead of itself because everybody believes we're having inflation. And we said the same thing with silver, and that's why we got out. It was a very good call, and that's really basically what we looked at the time. Then there was something else. If I can bring up the chart. Oh boy, there was also gaps in spot gold, which is a very, very rare thing to see. Spot gold, which trades 23 hours a day on the charts, actually gapped up into that night's high on January 29th. That's when I said we got to get out. You don't see it gapped and reversed, and that's when we got out. So there are many reasons. On a fundamental basis, we do not believe that gold is anything other than a commodity. All commodities should hedge against inflation one way or another, especially a commodity like gold, which doesn't get consumed, which people do use as a monetary source, which has a very, very, very liquid market. So if gold is going to if gold's going to move up because of inflation, there's no reason for gold to actually outpace inflation. And you look historically in the United States, going back 100 years or so, gold has only outpaced inflation by about 1.5% per annum. So this was far more than 1.5% per annum. So, we're likely to see gold back to this level at least, which means, maybe, you should see pullback in gold. Now we went long, we're long gold, long 5% gold, 5% silver, 5% the GDX. And that's again based on the fact that they had such large corrections. We're thinking maybe we'll just get a tactical rally, but we're not changing our long-term view, which is basically bearish gold and bearish silver and bearish gold stocks as well.
Okay, so just going back to my question then, when interest rates rise, are there specific sectors that will do well? Financial stocks, for example, the earnings of the last quarter of the big banks were fantastic. What do you expect to happen?
Well, I think the bank stocks have been doing well, and if interest rates rise, bank stocks could continue doing well. I don't think there's any one sector you can say will do well when interest rates rise. I really can't
Yeah.
think of any sector historically you can really pound the table and say, if interest rates rise, this sector will do well. Gold should not be a sector that does well when interest rates rise. Certainly, technology should not be a sector that does well when interest rates rise. But technology stocks should do better than non-technology stocks, at least historically. Now, this has changed. Historically, the great technology companies had no debt or low debt. They didn't borrow money. They were just cash cows. They'd buy back their stock. This has changed in 2025 and 2026. It's going to change in 2027 and 2028 because now these companies, what you call them hyperscalers, they're involved in AI, and they're starting to borrow money, trillions of dollars for the first time. So in that case, as interest rates rise, the cost to borrow money goes up. To the extent that what they borrow is not fixed, it's going to affect them. And to the extent they have to borrow more money, as rates go up, they'll have to pay more for what they're borrowing. So that's another reason to say that this time around, interest rates should have a greater negative effect on technology stocks than it's ever had in the past. That's what I would say. This is just a chart it's not my chart, but this is Amazon, Microsoft, Google, the hyperscalers, showing the CapEx estimates, and they're financing this through debt. So you're talking about, trillions of dollars that's going to be borrowed through 2007, 2028. So as I say, yes, so maybe interest rates this time will have a major negative effect on these technology stocks. I want to show something else which people are making a mistake about, and that has to do with the PE of the price earnings ratio of the Nasdaq. Let me see if I can find that chart here. See, people are claiming the Nasdaq P is so high. This is a chart of the blended forward 12-month forward P ratio. Now, at the 2000 peak, look where the P ratios were, 80, 70, 60, 50. Now we're 24 times earnings. Now, I'm not saying this is cheap. And if people who just value stocks based on the present value of future returns will say at 25 times P is high. But the market never values stocks based on present value future returns. The market values stocks based on growth, potential growth that is not necessarily included in the current price, and also based on speculative sentiment. People won't own stocks because they don't want to hold cash. People won't own stocks because they think it can do better than buying a house. So there's a lot of speculative elements and sentiment elements that go into stocks. So the fact that it's trading at 24 times earnings, to me, is not a reason to worry about a bear market. Not at all. We've seen it much higher. And look at this. The bear market in 2008 began at a much lower PE. The bear market that began in 2000 began at a much higher PE. These things fluctuate. You can't make any hard and fast rule as to what type of PE will top the market. Just a side note, the famous market analyst Benjamin Graham, the fundamentalist, never got it straight. Never ever got it straight. He always felt the market was overvalued based on his measures of valuation. And that is because he was under the misconception that markets peak when they get overvalued, and not understanding that markets can get overvalued and more overvalued and retain their overvaluation for years or even decades. There are some analysts out there who have been bearish for decades strictly because the metric they use is valuation metrics, historical valuation metrics. We're very careful not to use historical valuation metrics. We'd rather use market data metrics, and that's more flexible and that changes along with the market, and that keeps you in bull markets and keeps you out of bear markets. Having said this, as you know, we basically all my career I've been involved in institutional money management. I managed money for hedge funds. I managed the largest gold mutual fund at Oppenheimer. I managed various equity funds. And my clients in this business I'm in now, Milton Berg Advisors, MB Advisors, basically are large family offices, large hedge funds, sovereign wealth funds, and so on. But we started a new product for retail investors, and we started this in January of this year. And the goal here is basically to own the S&P 500 during bull markets, just hold it, not leverage, buy and hold, don't trade, and to get out, not prior to a bear market, but once the bear market takes hold. Like say, well, the market's down 8% or so, we'll give the benefit of the doubt that there's a bear market coming unless we see some buy signals. So to show you a little bit about how this works, this is the number of trades for the retail model per year. As you can see, some years have 0 trades. Some years have only 1 or 2 trades. I think the most we saw were 3 trades in the year 2002. So this is for investors who don't want to have to look at their screen every day and have their advisors call them up and tell them, get in the market, out of the market, buy stocks. These are the people who really just want to trade, once every 1.25 years and out from the market. The model historically has gained 18.5% per annum, mainly by being out of the market during bear markets and getting in within days of a bull market. Our buy signal in 2026 occurred on April 10th, excuse me, which was 8 days after the low, which is really late. Most of our buy signals take place within 1 to 5 days of the low, 1 to 4 days of the low. So we're a little late, but yet the buy signal is working. The market has rallied. We're still long, 100% long for the retail clients. And I don't know if most of your people who watch your podcast are retail investors or individual investors. I'm sure they are. They should take a peek, miltonberg.com, and just because I think it's the end of my career. This is a fascinating product. I made it specifically for individual investors. I made it easy. Get in the market, buy the VU or the SPY, hold, and only get out when there's a likelihood, more than random likelihood of a bear market, and wait for the next buy signal. This has worked very well for us. That's another thing I want to show you. I want to show you one other thing before we go. I guess we're going to have to go soon. I want to show you one other thing before we go. We said we had quite a number of buy signals in April. I made a folder of each buy signal and where it projects the S&P to go. So for example, on April 14th, we got a buy signal based on the fact that the S&P was at a 30-day high just 10 days after a correction of 9%. That's all we needed. In the past, this has happened a number of times. In the past, the median gain within 12 months is 28.40%. But this just shows where we are today. This is through yesterday's close. Right here, we're in line with historical returns. In other words, the gain of the S&P since the signal is in line with the historical returns, which had a median gain of 28%. Like here's another signal again on April 14th. In this case, we're underperforming, you see. In this case, we're still in line with historical returns. So I'm tracking. I want to see if my April signals fail. I will see it right here. See, this is still in line, which tells me the April buy signals, which earlier in the day we said projects to anywhere between 8,200 in the S&P or 8,900 in the S&P. As long as we're still in line with historical returns, I make the assumption that these buy signals are still in effect. This signal, for example, generates a median return of 21%, and this is, again, still in line with historical norms. And this is underperforming. So right now, 2/3 of the signals are still performing as expected historically. So if you ask me why, I could give reasons to be very bearish and call for a bear market, even based on technical data. Forget about fundamental data, just looking at the action, the KOSPI, the action in the semiconductors, the fact that the margin debt is so high, the fact you saw island reversals at the top. All of these factors can tell you that there's a bear market ahead, but I'm not ready to pull the trigger and claim bear market because I'm very confident in the models that I've created. And since most of the models are still following their historical returns, as you can see, we're not going to throw in the towel until we start seeing more underperforming. Like here's an underperforming one. This is a signal that signaled twice in the past. The returns are 39.02% per annum, the median return, and we're underperforming. So that's the reason really why we're bullish. I understand all the bearish cases, overvaluation. Some analysts saying interest rates are too high. Some say Fed's going to tighten. Some say that the borrowing by the technology companies. Some say AI is just a farce and these companies are going to get battered. But we're going to stick with our models, and our models are long. As I say, our retail clients are still long, and institutional clients are short, but we're short tactically, and we're looking to get in, and we'll see evidence when that evidence comes.
Excellent.
Okay.
I appreciate your time, Milton. Good to see you again. Tell us where we can follow your work and to subscribe to your services if we want.
Retail investors can look at miltonbergedge.com, miltonbergedge.com. And that we have a service, $10 a month. It's an amazing service. It's made specifically for the simple, easy retail client who wants to trade easily and not have headaches and not have to worry about the market each day. And our institutional clients, again, who get all of our work, it's miltonberg.com, miltonberg.com.
All right.
Thank
you very much,
David.
Milton.
I enjoy it. Thank you. I hope this was a good interview. I think I enjoyed it. I have so much more I could talk about.
Yeah.
This should be it for now.
I enjoyed it as well. I enjoy your commentary as always, and we appreciate having you back on. Thank you very much. Please do follow Milton in the links down below. Thank you very much, Milton.
Thank you,
Enjoy
David.
your summer. We'll speak again soon.
Great. Thank you, David.
Thank you for watching. Please do like and subscribe. Follow Milton Berg in the links down below. And don't forget to use my code LIN, L-I-N, when you sign up to KOSPI. Remember, new users who use my code LIN, L-I-N, can get $500 when you sign up and trade $25.